Welcome back, everyone, to the Bitcoin Business Bureau. I'm your host, as always, LitecoinLeader, filming several videos today, and I'm a little bit loopy, but I've got a good one for you today. Not to steal from I allegedly, but I'm going to talk about something that you may have heard of, and if you haven't watched The Big Short, or you don't know what that was about, or the global financial crisis of 2008, I really recommend going to watch The Big Short. It is a great movie. They will explain a lot of these different complicated terms. I've already explained, hopefully I remember to link it over here, but I explained credit default swaps, but this one is about mortgage-backed securities. So I'm going to do both of those back to back and hopefully link them back together. Maybe I'll make a playlist, we'll see. But I want to explain mortgage-backed securities and what that means. So what happened in the 2000s is that someone got the bright idea that, normally what a bank creates a mortgage. They create a mortgage out of thin air, right? With the hopes and the dreams of selling it. So if Harry and Henrietta's homeowner, I'm not going to say that again. If a couple wanted to buy a house, they go to the bank and they say, hey, can we get approved for a mortgage? And they go, they try to get pre-approved, they get qualified, they do all the numbers, blah, blah, blah. This is the amount of house you can afford. They do all the paperwork. And they said, here's your pre-approval letter. Then they put an offer on a house and they get approved and they're going to buy a house. And then they come back and said, all right, we're going to get a $500,000 mortgage. Bank sits down, writes out the terms of the mortgage, gets it all set up, sends the terms over to underwriting, and they get everything written up according to how they're going to sell it. So they are writing a note in favorable terms for it to be sold on the marketplace. Okay. Because when they create their mortgage, quite often, this was commonplace 20, 30 years ago, even back then, your mortgage will be sold to someone else and they wouldn't service it. Before then, I'm talking like 40, 50 years ago and beyond, banks usually kept in-house mortgages. They would write a mortgage, they would keep it in-house, and you would make payments to that bank. Now what they do is they sell the whole mortgage at a discount, and they get, so that if you have a $500,000 mortgage and underwriting does everything they're supposed to do, and that's why that's so difficult to get through underwriting, is they are trying to match up the buyer's terms to your mortgage and make sure that your mortgage will qualify and you will qualify so they could sell that mortgage on the market to that next person or that next company. So, and I'll just name, so let's just say you go to Wells Fargo and you're open a mortgage, but the Wells Fargo is going to sell the mortgage over to Chase. Okay. And that could be for cashing it out right away, managing risk, all that kind of stuff. So what happens is that back in the 2000s, you had all these mortgages. Then what they used to do is they would take like 100 mortgages and put them together, and they would have different levels of risk associated with them. Excuse me, dropping my props. All right. So back in those days, what they do is they take the best, they cream the crop, and basically they'd have like four. I'm just represent with four, and that's not it. Where did my other aces go? Fall on the ground. Found three. There's the fourth one. They fall. Hey, this is what happens. But they'll put these together, and they've got, okay, I got four aces. Let's see if I can get it right. These four aces are going to be put into a security all together, right? Rather than having four mortgages sold individually. And I'm trying to spread them out properly. There are four aces. There we go. We're going to bundle it together, call this a security, and I'm going to sell this on the market. Okay. Now, this is AAA rated. They're all aces. They're great. But now I'm like, okay, well, now I've got some kings and queens left over, right? Can I put them together, right? Can I put some royalty together, bundle those? Well, yeah, I can, but that's like, instead of AAA, they're kind of AA, but we'll still buy it and you move it over to the marketplace and sell. So what happens later on, as we get to like the middle of the 2000s, they sold all the aces and kings, right? They sold all the good ones. Now you're down to jacks and tens, and now we're into like the B level. But people, the process is so greedy. Everyone in the process is so greedy. They're not checking everything. So now, instead of dealing with the jacks and tens and sprinkle in an ace and a queen just to get like a straight and whatever, now you got like eights. Now you got like a two, a terrible one in there, and you bundle all this together. But now, like, you've got it. Sure, I got some aces, but I've also got some kings, and I've got jacks, and I've got these eights and twos all bundled together. This is my new bundle, and I'm going to sell that on the street. But they're going to call it AAA, or they're going to call it AA. Now, these mortgages are risky, right? But they're being characterized as like their level of risk based on like their rating, and the rating houses are competing with each other. Moody's and I think Barron's might be the other one, but they rate these mortgage notes. They rate these bundles and they say, oh, yes, AAA, AA, but they don't want to downgrade these because then they'll go to the other guy across the street and get a rating from them. It's competition. It's kind of like Coke and Pepsi. All right, there's like the two rating houses that are competing each other. So they want to get like the one who gets the better rating is going to be more favorable, gets to work, and so on. So in any event, you get all these different mortgage-backed securities with, instead of just aces and kings, now they got some twos and eights in there. Then they're being dumped on the street, but they're listed as if they're like, aces, kings, and queens. So there's hidden risk to this product now because all the good product has already been sold, bundled, and now on the street. So now, fast forward a couple of years later, we get to 2008. We have mortgages that are about to die. They're starting to default. The risk is too high, and now the joke is on everybody. So now these jokers the jokers were originally the ones that put these securities together, claiming they're AAAs, and now the joke is on everybody else because it's all gone. So the banks that are left holding them when the music stops, and the banks that buy these mortgages or mortgage-backed securities, and the underlying notes, instead of performing at a 99.9% rate of not failing, now they're failing at 4 or 5%. Now it's like 95, 94, 93. And now that's the double and triple A's. Now you get to like, your eights and your twos again, and they're failing at 10% of the time. So that's where things started to implode. And that's where like they also started playing the credit default swap game, which would be another video that I'll make. We'll talk about that next time. But for now, hopefully you understand what a mortgage-backed security is. It's basically just a grouping of cards, a grouping of mortgages, all sold as one package. So you get 52 for the price of one. And hopefully you get more aces than you get deuces. Hopefully you like the props. Hope you like the video. All feedback is welcome. Leave a comment down below. Like, share, subscribe, all that cool stuff. I would love to. What do you think? Do you understand the mortgage-backed securities a little bit better now? Do you understand what that is? Are you ready for the credit default swaps and how? I know you can't wait to read about them, but have you watch The Big Short? I would love to hear about that too, and what you think about that movie. All that good stuff. Leave a comment down below. But for now, I'm going to close the drawer in the bureau, say follow leader, and I'll talk to you soon. Take care.